If you've been meaning to start investing, but every time you go to do it, something stops you, then this video is for you. Maybe it feels too complicated. Maybe you're not sure you've got enough money yet. And maybe you're worried about getting it wrong. But by the end of this video, you're going to understand exactly why investing matters, how it actually works, and what to invest in a way that's really easy to understand. But before we get into it, a quick note. My name is Melanie Davies. I'm a licensed independent financial advisor. You can find more out about me on the Financial Advisors Register, which is linked in the description box below. Everything I share on this channel is general in nature, so it's general advice only. Everyone's circumstances are different, and what's right for one person might not be right for another. My financial services guide is also available to download below. Okay, let's get into it. This is part one of a complete beginner's guide to investing in Australia. And today we're going to cover why you should invest, how compound interest works, what inflation is doing to your savings right now, how the share market works, and what to invest in, including index funds, ETFs, which are exchange traded funds, and how to personalise your approach. In part two, we'll cover where to open an account, when to start, how much you need, and all the costs and tax considerations you need to be across. Okay, so why do you want to invest? Why bother? Most people save, they put money in a bank account and it sits there and they feel really good about that. And savings is really important. But savings alone won't build you wealth. So how come? Well, the two main reasons to think about are compound interest and inflation. And once you understand both, the idea of not investing will actually start to feel riskier than investing. Okay, so what's compound interest? Compound interest is easy to ignore and overlook, but once you see how it works, you'll understand why it makes such a big difference to your balance over time. And here's the simple version. So let's look at $10,000 invested at 8%. So after 10 years, it becomes $21,589. After 20 years, it's over $46,000. And look at it over 30 years, $100,000. So it becomes $100,000 in 30 years without actually adding anything. So now let's picture if you're also contributing to it as well. It gets pretty exciting. The key insight here is that the earlier you start, the less work you have to do. All you had to do was get started. Okay, let's go over inflation real quick. Now, inflation, this is the one why leaving all of your money in a savings account carries a risk. Inflation is the rate at which the cost of living increases over time. And in Australia, the Reserve Bank of Australia, the RBA, targets inflation at roughly 2 to 3% a year. Now, we know that we're running hotter than that at the moment, but let's work through an example. So if your savings account is earning, say, 2% interest, but inflation is running at, let's say, 3.5%, your money's going backwards in real terms. This means it buys less next year than what it did today. So the number in your savings account hasn't actually changed, but it doesn't stretch as far as what it used to. So investing in assets that grow faster than inflation, like shares historically, is how you protect and grow your wealth in real terms over time. Okay, so how does investing work? Well, let's talk through the share market. What actually happens when you invest in shares? You're buying a small ownership of the company. If the company grows and it becomes more valuable, so does your shareholding. So the ASX, that's our exchange, is where Australian shares are bought and sold. Think of it as a marketplace where people buy and sell their shares in companies. So let's look at what the share market has actually done over time, because this is the part that tends to get people's attention. The Australian share market has delivered an average annual return of around 9% per year over the last 30 years, including dividends. US shares 11%, international shares, let's say 8%. Now, this is really important. That doesn't mean it goes up every single year, and you probably know that. The share market fluctuates a lot, and that's completely normal and to be expected. But over long periods of time, say 10, 20, 30 years, the historical trend has consistently been upwards. The investors who build wealth are typically the ones who understand this and invest in quality and stay the course. The ones who struggle are often the ones who panic when the share market falls or swings and sell at the wrong time. And that's a perfectly normal human reaction to run when in fear. But volatility is the price you pay for long-term growth, and that's why quality matters. It's not a reason to avoid investing altogether. It's something that you learn to accept. Let's move on to what should I actually invest in, and let's look at the case for index funds. Here's where I want you to make your life a little bit simpler. You don't need to pick individual stocks, and you don't need to predict which company is going to outperform the market next year. Quite a number of professional fund managers really struggle to outperform the market over the longer term. So what's the alternative? Well, it's index funds. But before we get into what they are, there's an important first step that a lot of beginners skip. You need to understand your own risk tolerance. And what's that? Well, your risk tolerance is how comfortable you are with your investment going up and down in value, because the right fund for you depends entirely on the type of investor that you are. Are you someone who would lose sleep if your portfolio dropped 20% in a year? Or are you comfortable riding out short-term falls for better long-term growth? There's no right or wrong answer here, but it's knowing where you sit that changes everything about how you should invest. A good place to start to try and work this out is completing a risk tolerance questionnaire, and I've linked to one or two in the description box below, which will help you work this out. I've also linked to a full video on low risk versus high risk investing. It's one that I've done. It's the secret to smarter investing, which is in my investing basics and strategy playlist. The link for that one is in the description box below. So once you have a sense of your risk profile, what do you actually invest in? An index fund is a great place to start. It's a type of investment that tracks a market index, like the Australian share market index, for example, or a global share market index. Instead of buying shares in one company, you're buying a tiny slice of all the different companies in the index. Think about it this way. One purchase could give you exposure to hundreds of companies all at once, like banks or healthcare or energy or, say, retail. So this means if one company has a bad year, the others help carry the weight. And depending upon the fund, that basket might be spread even further across different countries, different regions, or different asset types altogether. So some funds focus purely on Australian shares. Others give you exposure to global markets or the US market or Europe or Asia. Some blend shares with bonds to smooth out the ride. So the point is, you're not betting everything on just one company or just one market. You're spreading the risk broadly. And that's one of the most powerful things about this style of investing. Once you know your risk tolerance, you can look for a diversified index fund that matches it, one that spreads your money across a range of asset classes in proportions that suit you. And look, that might be mostly shares if you're a growth type investor, or a blend of shares and bonds and other assets for someone who wants a smoother ride. In Australia, index funds are most commonly accessed through ETFs. That's exchange traded funds, which trade on the ASX just like shares. You buy and sell through a broker or through an investment platform. Now, not all ETFs are index funds. It's worth knowing that. Some are actively managed, and others follow specific strategies like dividends or technology or ESG investing. But many simply track a market index like the ASX 200 or the S&P 500, which is exactly what we've been talking about here. And that's what makes a passive index ETF such a practical tool for a beginner. It's simple to access, it's broadly diversified, and it's generally lower cost. So let's go through ASX codes and APIR codes. What are they? Here's something you need to know about when you start researching investments here in Australia, the difference between ASX codes and APIR codes. ASX codes are short letter codes, usually 3 to 4 letters, that identify an ETF or a share trading on the stock exchange. You use these to search for and purchase an ETF or a share through a broker or a platform. And when you're researching, you'll come across these codes regularly. APIR codes, though, they're different. They're used to identify managed funds, investments that you access through a fund manager or through an investment platform directly, rather than through the stock exchange. They look something like a short alphanumeric string. If you're investing through a certain platform or exploring managed fund options, you'll come across these kinds of codes. Understanding the difference means you'll know exactly what you're looking at when you're doing your own research. Okay, so let's quickly chat through personalising your investments. What you invest in depends upon factors that are specific to you, and this is where general advice has its limits because the right answer varies from person to person. Some of the things that shape an appropriate investment mix include time horizon, how long before you might need your money back. Someone investing for, say, 30 years can generally take on more short-term volatility than someone who needs the money in 5 years. Also, risk tolerance, so how comfortable you are with your portfolio going up and down in value. It's about what you can sit with without making negative decisions. Goals are important too. So, are you investing for retirement, financial independence, a future property deposit, or something else? So, your goal really does shape your strategy. A growth-orientated portfolio weighted towards shares tends to suit investors with a longer time horizon who are comfortable with volatility. A balanced or conservative portfolio includes a mixture of growth and defensive assets, which smooth out the swings a bit more, but typically deliver lower long-term returns. This is exactly the kind of conversation a financial advisor can help you work through, because getting the balance right for your situation is really important. Okay, so let's wrap it up. Let's recap what we've covered today. You now understand why investing matters. It's about compound interest, which rewards you for starting early, staying consistent, and we now know about inflation. That erodes the value of your money that's sitting still. You also understand how the share market works, fluctuations in the short term, but that long term, historically, the trend has been upwards. Volatility is the price you pay for growth. It's not a reason to avoid it. And now you understand what to invest in: index funds and ETFs that give you instant diversification across hundreds of companies, regions, and asset types in one single purchase. And you also know the difference between ASX codes and APIR codes, and how to think about personalising your approach based upon your time horizon, your risk tolerance, and your goals. So in part 2, we're going to get into the practical side: where to actually open an account, when to start, how much you need to get going, and all the costs and tax considerations you need to understand before you actually begin. And if you don't want to miss it, make sure you subscribe so it comes straight to you. And if you have any questions for today, drop them in the comment section below because I will definitely read it. Everything mentioned today, including my financial services guide and my listing on the Financial Advisors Register, is linked in the description box below. Thanks for joining me. Can't wait to see you in part 2. I'll see you then.